Okay, good afternoon. This video, it was part of a webinar I did a couple of weeks ago for a broker, but I thought I'd share it with you. It's obviously titled High Volatility in the Oil Market, and when you look at the reasoning behind the subject here, it was quite clear at that time. Particularly, there's nothing more exciting than volatility and headlines, and we've seen a hell of a lot of both at the time. Now, this hasn't died down too much. In fact, we just literally, as I'm recording, just about to record this, we saw a message come up here: Saudi Arabian energy minister to cut production by an extra 1 million barrels per day in June. So they're reducing back down to 7.49 billion barrels a day. So sorry, million barrels per day even. Did I say billion? There we go. Just getting numbers more exciting for you. So there's this, as I say, excitement. Oil is a great headline grabber at the moment, and for good reason. Now, when you look at the markets themselves, most traders have been enticed into trading over the oil over the last few months, with knowing very little about what they're actually trading in terms of their contract. Now, when I recorded this, there was 77% of XTB traders. I was just looking at it on XTB. It's the broker I was doing the webinar for. Were actually long. They're currently sitting at 81% is currently long on there at the moment. So the desire to get into something when it's cheap or expensive and selling it the other way is something we can't avoid often as traders. We want to be in on it, and oil is certainly no exception at the moment, and it's still no exception. Now, many got caught out and will get caught out when contracts are changed. They do not exactly understand what they're trading, and it's, as I said, if you just see the price of oil on your account and nothing else, you need to find out what it actually is that you're trading in. With XTB, which I was doing this presentation for, when I was looking at theirs, they were looking at a contract, but not the first month, the second month out. So it was 2 months out. So they were looking at a slightly less volatile contract. Now, I'm going to come on to explaining what you might be trading in a moment, so you get a better understanding of what's really behind the prices that you're getting quoted. As I say, some get caught out. Certainly we saw some negative price action recently. Some would have lost their positions, obviously, when those positions changed, particularly if their broker left it very late, because it went down into a negative situation. So it pays to work out exactly and find out exactly what you're trading, or what the oil price that you're trading is based on. Very important. Okay, as I said, the thing with oil, sometimes you just can't give it away. Traders actually paid, it was actually $37 a barrel they were paying not to take delivery. So that's quite a headache for you. And it has become a massive storage headache. Now, things have changed a little bit in a couple of weeks since I've done this, and the oil producers have started reducing. And as I just said, that Saudi have just announced they're going to reduce some more. But at the same time, the world economy may take quite a bit of time to get back to where it was, and even when it was, there was too much oil being produced. Without any doubt, there was arguments going on before it even sort of kicked off into this situation with the COVID-19 virus. So it's been a headache anyway, storage. But quite often, tankers were literally used and just sitting there, not even the oil on board, not even sold. So there's 1 in 8, I think it was, a couple of weeks ago, quoted to be sitting there with oil on, and not actually, with nowhere to go, and not even sold, because they had nowhere else to put it. Now, oil is traded on the spot markets, the futures markets. You can trade it through funds such as the United States Oil Fund, USO, as it's an exchange traded fund. You can trade it on options. There's other ways of trading oil if you really want to go out the spread betting, of course, which is maybe you just still need to know what you're actually spread betting, because it may be WTI quoted as or something similar. You still need to know whether that option is, or that what you're trading is not going to move significantly because of an expiry date. So price wise, when you're looking at oil, it's not completely straightforward. I could show you a chart here showing you all the different types of crude out there, the sweet crude, the Canadian oil sand crude, etc., and nothing it's not all exactly the same price. I mean, oil sand is a horrible very sulfur rich, I believe it is, but it's certainly a difficult crude to deal with for some. So it's valued a lot less. Some of the lighter oils, like light crudes, are of more benefit. Saudi produced their particular type of crude is particularly still bought, although the US can provide all the oil they need themselves. They still buy them from Saudi because it produces a crude which can be easily made to make diesel. So it isn't always, as I say, it isn't all equal out there, but the current prices and benchmark prices that you'll see are generally Western Texas and Brent crude. So they're the two benchmarks that you'll see when you come to trade. Now there are, as I say, there's plenty of other prices quoted out there for those individual oil sources, but you will find on your trading account generally, which whoever you trade with, just the two sources, WTI and Brent. Okay, so what are you actually often, or what is the price being, where's it coming from? Often it's coming from NYMEX, often if it's WTI. So your price would be NYMEX prices, and often the futures. So you'll be in the current month, or the front month, which when I recorded this, it was still sitting there, which is good. The front month at that time was May, so that was the contract that was still being actually just expired actually. Product codes, etc. You get the first trade and the last trade. First trade is when that particular contract was available. Now you've got to remember that whilst we're looking at speculating probably on a daily basis, intraday basis, sometimes a weekly, a swing basis, a lot of people are looking far out to the futures because they want a known price so that they can actually build that into their own prices. If they're a refinery, they want to know that the price of crude that's coming into them will be a specific price, so that they know that they can then price and sell the futures of the refined products at a certain price as well. So it's all linked in. So the prices go far out. I mean, 2014 was this May 220 contract. You could have traded it back in 2014. Some of these others look 2011, 14. So some of them were available to trade from way back. 6 years ago, basically, around about. And then you've got the last trade. So this is the settlement date, and this is very important to understand settlement dates when you come to trade in oil, because if you're literally unaware of it, all of a sudden the price jumps quite considerably. Now, depending on how your broker handles that, you may just see your price effectively requoted to the next barrel price. I'll show you that in a moment. But these settlements are important. Now, one thing that's happening at the moment, many brokers are writing to people, and I'm seeing plenty of brokers writing to me to tell me that they're going to actually be changing their contracts. So instead of leaving it up until about the 19th or 20th of April, XTB, for example, I think they switched around at the 16th of April. So they took out some of the risk of the actual settlement day itself, because settlement days, as I've said, minus $37. It can be quite spooky, but not normally that spooky. But what they're doing is that they're either settling it early, so they're moving across. I've already had one this week. I can't remember which broker it was that they literally suggested that they were going to change. I'm just quickly looking through here. but they're actually going to change. I think it's later this week. They're going to switch across from that 19th May. So that's coming up next week. So it makes sense. It's going to be this week, and I think a few others will be following, be changing from that 19th of May, switching through to the July or August contracts, and that's what they'll be basing their prices on. Okay, the rest of this is immaterial for you at the moment. The next important thing to be looking at is actually this was taken, as I say, a couple of weeks ago. And you see the price of oil there, $12.07, $17.97 for the different contracts. That was the price of those contracts at that time. So looking at December 2020, we were looking at a barrel costing about $27.45. Now, I spoke to our guys. We had a members day, and when we did the members day, I said, well, it should get round back to about $30. I was sort of looking at that as being a sort of a level. Well, it's not too far off. However, since this, I'm just going to bring up another page here if I can. Let's move this out of the way and switch into this page. And sorry, it's a little bit wider, but a little bit different. Well, things have changed. That June contract now is now sitting there at $24, and you can see right up to the December, which is now $31. So why has this changed? Well, different expectations. There's the things starting to unwind in terms of the closures, and so as those closures unwind, companies start producing, or manufacturers start manufacturing, and the demand for oil increases. On top of that, we've also, as I said a moment ago, we've had the likes of Saudi cutting back. Production cutbacks have been put through. Now, Saudi really started this, the big problem, as I say here, by literally setting an out-and-out war effectively in terms of trading recently, and they started the price war, but they've now sort of changed things somewhat. But anyway, this is the new expectation, so quite a change from what we were looking at. If I can get back to here. Back here, sort of it's 24 and 22, 24, we're sort of sitting at 24, and you're seeing this right away back up to 31. So quite a change. Now, the volatility, obviously this has only moved $4, this has moved $12 or more. What did I say that was previously? It's 24 now. So that's moved $12, that's doubled. This has only gone up $4. You can see the difference in, and this is why brokers will price you generally 1 or 2 contracts out, because they want enough liquidity, or volatility rather, in there to make it interesting to you to trade and for you to get the movement, but at the same time there will often be trying to some sort of element of safety, particularly for these rollovers when we could see bigger problems. Now I'm just going to point one other thing out here, and I'll bring it back later on, don't worry, otherwise I'm going to lose the flow of what we want to show. Now, obviously recently with what happened here, and this is, as I say, this is taken from XTB, sorry I can't make this any bigger, but you can see quite well here that their price, they actually popped it up earlier on. As I say, I think it's about 16th of April they moved their price up there, so it's earlier, and then price started selling off from that, of course, and then the expiry day was there at the 21st, and that was the big sell-off there. But this occurred with the new contract. So you can see the new contract still moved. The next contract moved all the way down to, or was it $5.50 or something in that region, all the way down. So that new contract, now if you hadn't been in that contract, you'd been at minus $37. It went down that far. So this contract, it took some of the steam out of that, but it moved down quite a long way. It then gapped up a little while longer later, as there was changes in wording and the agreements, etc. But this is the sort of thing, and this is why you've got to be careful what you're doing, ensuring that you're getting the right contracts, or you know what contract you're in. Okay, so looking at supply, so supply's been outstripping demand for quite some time. As I said, it would actually happen before the situation with the COVID-19. It had been kicking around and been talking last year about oil levels, and oil had been sort of up and down a little bit, but stifled somewhat. One thing that's changed over the years, and the US has become the biggest producer. I mean, that's somewhat. I mean, it was about fifth or sixth at one stage. Of course, it was the biggest producer originally, but it easily got beaten there. But now the US has more oil than it can actually use itself effectively, but it can actually export some of that. But it's still, as I say, it still imports oil of particular quality. But so the US have become the biggest producer, but the other producers such as Russia they've become more efficient. You've got the oil sands. There's a stack of new production there. You've got it's always search. There's always new. I say always new drilling. There isn't at the moment, but there's often new drilling and looking for new sources of huge oil. There's a lot of on tap oil at the moment as well. So that's the more important thing, because it's current supply. It's not future supply. It's current supply. It's sitting there at the moment. Now we know that OPEC, another producer, had previously failed to agree on the production cuts, and it was the 6th of March when Saudi actually promised it would flood the world with oil, and they went flat out to do so. Not only did they flood the world with oil effectively, they also reduced prices themselves to take more market share as a point. Now that could still backfire on them, which I'll come on to in a moment. Now COVID-19 was the key to reduction in demand. Now we saw I'm just looking to see if I've got the numbers now. I had the numbers written down there. The demand normally is about 94 billion barrels per day. Now that dropped by about 30 billion barrels a day, as I seem to remember. So that was a significant reduction. Now even now it's probably only gradually building up there. So it's still a slow sort of, and it certainly won't be immediately back to those 94 billion barrels a day as a world number. There's a knock-on effect from traders unwinding fund positions as well. Now that was a couple of weeks ago. That's been pretty much done. We saw like the double move. Let's just come back to a daily picture here. We saw this sort of double move. It sold off and then sold off again later in terms of price action as traders I say traders, it was the USO, literally cut the size of their positions, all front month positions effectively. So they were cutting the front month positions. They were told they had too many. I think they were actually told to cut positions. So again, that reduced demand effectively out there. So looking forward, this is my reasoning to think it would get back to $30 and above towards the end of the year and the longer term. Many oil states rely heavily on the price of oil in terms of their income. It's huge income for some states, particularly Saudi. I think it's 47% of GDP. I'm just gradually just looking to pick my the page up with the actual figures in there. Just picking up average. Sorry. It's 42% of GDP. Got it. There you go. So 42% of GDP was for Saudi, and so you can imagine what sort of effect. It's around about 8% for the US. So that's a huge effect on GDPs. They cannot afford to be, particularly the Saudi, cannot afford price of oil to be as low as it is, because they just haven't got the funds to do what they need to do infrastructure wise, etc. So what we're most likely to see is more mothballing, as I say. The other thing that might still happen, and this is why we're seeing Saudi, I believe Saudi are backpedaling big time here, is the US were considering, they've already gone, it's already gone through one house. There's a paper there considering a movement with NOPEC, as in making OPEC illegal, because it's they're basically just setting the price, and it's illegal and everything else to be setting prices just about, and there they are setting the prices. So on that basis, that's been put, as I say, it's put put through one of the US houses, but it's not been put through the second. Part of that is obviously because the US at the end of the day wants to see reasonably good oil prices, because it means so much to their own GDP. Even at 8% of GDP, it's still a reasonable amount of GDP. So that might be why they haven't absolutely pushed this through with Saudi, etc. But there is this potential that it could go through and push OPEC through, and at which time it could be really bad news for Saudi overall. But it sits there in the back line, and I think that's, as I say, why we're seeing Saudi sort of reducing quite considerably now. Okay, looking forward. So we've got to be looking forward to unwinding of the June volumes. Now this is, I'm going to go. Oh, I don't need to. I can go forward. It's okay. I've got a slide that's coming up in a moment. We've seen that already. Now the June volumes have been dropped back significantly. In fact, a lot of the volumes have been dropped back significantly. 19th of May is the next settlement date to watch out for. Brokers have been taking action, as I said. With some of them, they're actually taking action in terms of with LMAX, my broker. They're actually using a indexing scheme. So effectively, oil is now 100 plus the price of oil. So they've effectively indexed oil. I'm just having a quick look to see. So it's now shown here for. He says, quickly looking through, there we go. So Western Texas, or US crude as they call it here, plus 100 is sitting at 126.2 on the sell side there, so 126.2. It's actually 26.2, but their plus 100 contract effectively allows any negativity. Now, when they were doing this originally, you could see that they were obviously getting ready for some real drop-off. Now, when I was looking at this, I was thinking, well, yeah, there could be quite a big drop-off, but things have changed considerably. As I say, this the unwinding of the June volumes has been pretty much done by a lot, which I'll come on to in a moment. One thing to watch as we go through is probably more OPEC plus meetings, so that will change, and the more the likes of Saudi do things to cut their production will be seen as a positive step. You can watch the US crude oil inventories. These used to be shown on a high profile on things like Forex Factory, but you can still see it. You just need to make sure it's on a yellow. It's on a Wednesday, and you'll see Wednesday afternoon 3 o'clock-ish. Watch out for their crude oil inventories, and it will give you an idea of how things are going there. Last week, actually, the crude inventories dropped a bit, so it's about half of what is expected in terms of numbers. But that is a very variable. Anyway, it does tend to chip up a bit and chip down a little bit, but that is still quite a clue in terms of looking at the overall trends there. As I said, prices. It's hard not to put a case for prices to increase based on the fact that the countries producing the stuff can't afford to produce it at the levels they're currently producing it and selling it for. So that in itself will help things. But as we get through, and hopefully quicker the better, we get through this COVID situation, demand will gradually ease back to those previous levels. Now, one thing to watch here, I was looking at the current futures. If I can just move this up a little bit, it's not completely all in shot. There we go. So you can see this here. Now, if you look at the volumes back here, you're near enough, so actually 600,000 contracts sitting on that June contract. Nearly 300,000, 290,000 in July. If you look at where they're sitting at the moment, gone. 31, 80, 16. In fact, looking forward to December, I mean, very thin numbers sitting forward at the moment. It's, as I say, very thin there. May lead to more volatility as we go through, and the coming months, and maybe even a few surprises to the upside at times. But certainly in effect, the demand here has dropped off quite considerably. in terms of, or the perceived demand here, the contracts are certainly much lower than we've seen previously. So from those 600,000, 300,000 to 90,000, and you can see there's 31,000, 80,000. So I don't think we'll see when this expires next week, I don't think we'll see quite the same sort of cutoff. So there we are, that's the oil. Okay, so I was just checking for questions here. So I'm going to round it up here. So this is the end of this video, but as I say, do watch out. I don't think we'll get such a big movement coming in at the expiry on the let's say 19th of May. I know it says June contracts, but it's on 19th of May. It's for delivery in June. Just watch out. Check what contracts you're actually dealing with. Very important. Check what contracts and when and if they get rolled over. Okay, hope you found this useful. Bye for now.